The kind of drip that Glenda is talking about is a dividend reinvestment plan. So sometimes employers will set this up where you can purchase company stock on a regular basis. You just set aside a certain amount of money, it goes in, and then all of your dividends are reinvested. So it's called a dividend reinvestment plan. You can have it there. You might have it at a brokerage account. A couple of different ways that you could have those. So the pros to those kind of plans are that they're automatic. So it requires little input from you. It just happens automatically. When a dividend is paid, it is just reinvested into the company. It also seems to boost the returns of a stock. So you have what's called compounding, which they call the eighth wonder of the world. So basically, when a dividend is paid, it just goes in and buys more shares. So you not only get the appreciation of the original stock, but you also get return on top of the money that you've reinvested. Another benefit can be that there may be low or no fees to actually have that done. I would rather see you be in charge of where new money goes in your portfolio. So I would rather not have dividends reinvested if you're doing individual stocks. If you're doing for the parts where you're doing mutual funds or ETFs, I think that can be a great thing. But for individual stocks, I'd rather see that money just paid into your money market account and you continue to manage your asset allocation. So as those dividends come into cash, it's going to make your cash a little bit overweighted. And if you're using our portfolio tracker, what you're going to see when you go to the output page is you're going to see exactly where that money needs to go. So maybe you've got let's just say last year, the energy sector did really well. It was one of only two positive sectors in the S&P 500 last year. So let's say that you started out with maybe just the right allocation to the energy sector in your portfolio, but during the year you had a lot of price appreciation and you had other sectors that pulled back, so you ended up way overweighted in energy. But let's just say that all of your dividends were being reinvested into those companies. Well, that's going to perpetuate your problem just a little bit. So if you just have your dividends going into cash, then you get to redeploy that money to where it really needs to go from an asset allocation perspective. It also, the dividend reinvestment plans can make your cost basis calculation a little bit muddy. So it doesn't really matter if it's in a qualified account like an IRA or a 401k, because you don't really have tax consequences unless, of course, it's in a 401k and then you want to take that stock out, which is another interesting thing that you can do in retirement planning if you have company stock in your 401k plan. So it makes that calculation a little bit muddy. Most custodians are really good at helping you keep track of your cost basis, but I've seen a few places in my history and my experience, I've seen a few places that didn't really do a great job of keeping up with that cost basis. So that could be another little issue there.